I think that optimism dies hard. I think that optimism introduces cognitive dissonance. That is to say, investors are good at ignoring negatives for a long time, and if there are ambiguous events, interpreting them positively.
Welcome to WONK. One thing most people assume about stock markets is that they're an accurate reflection of what's happening in the economy. It's why politicians and CEOs actually do care how they perform. They're kind of a scorecard. But as we all know, markets can also get terribly disconnected from reality. And it was actually those moments historically where the opportunity's been the greatest. Let's agree on something else, though. Nothing about markets or politics feels typical right now. So that has us wondering, how do the world's leading investors make of what's happening? Howard Marks is co-chair of Oaktree Capital Management. He's something of a legend in the investing world, to be sure. He's also an author whose in-depth regular memos are read by those in the industry and well beyond. They're must-reads. I couldn't think of anybody better to ask what is going on. Howard, thanks for being here.
Pleasure to be here, Amanda.
So I did want to start. One of the reasons I thought of you is, the U.S. economy, leaving aside all of the noise, there's a lot of noise, but just the U.S. economy. We got the Beige Book this week, which economists look at to see the activity in the economy. It's at what you would call stall speed. It's not growing. The market, which should be a forward projection of how the economy is doing, theoretically, is hitting new highs. That's a weird disconnect, and then we'll get to the noise. But let's just start with what you make of that disconnect right now.
Well, I think, I agree with you. Not just the stall speed of the economy. To me, the economy is doing reasonably well, although growing slowly. But more importantly, there are other things. I think that a great deal of uncertainty has been introduced into the picture with, the tariffs and the legal pushback against those. The question of Fed independence, I think, to me, is extremely important. The constant amassing of national debt with nobody trying to do anything about it in the short term. These things are all very important. They all introduce uncertainty into the equation. And yet, as you say, the S&P 500, which is our main gauge of the stock market, was considered expensive given its valuation level at the end of 2024, and it has gone up in the face of increasing uncertainty this year. So it's more expensive now. I tend to agree with you.
In fact, this is not, you write about these numbers in your most recent memo. And in fact, I'll come to this, but you actually have shifted slightly in where your position on the market. And I think that's really important for people who care about markets and their own investments to understand. Howard Marks has shifted slightly. He's at DEFCON 5. We'll come to that in a minute. But DEFCON Invest 5. Last April, Trump's so-called Liberation Day, was a weird day for the world, a frightening day for the world. And I don't know about you, Howard, but the kind of weird list of countries with random tariffs assigned sent a chill down this business journalist's spine, because we were in uncharted territory. There was no rhyme or reason. There was no rationale. And the markets did what you might expect, which is run for the hills. But it was so brief. In retrospect, it was so brief, Howard. And yet nothing's really changed. Why do you think there's a persistence is it optimism? Is it greed? Why do people say, actually, this is a buying opportunity, which is what they said last May?
Right. Well, look, the memos that you mentioned in your introduction, which I've been writing for 35 years, all of which are available at oaktreecapital.com under the heading of Insights. And this isn't much of a commercial since they're free. I wrote the last one a month or so ago, called The Calculus of Value, in which I talked about these things. And, I said that, number one, investors are by nature optimistic. You have to be by nature an optimist. What investors do is they give up their money for a while in the hope of getting more back later. So that is, by definition, optimistic. I think that optimism dies hard. I think that optimism introduces cognitive dissonance. That is to say, investors are good at ignoring negatives for a long time, and if there are ambiguous events, interpreting them positively. There are also some actual positives at work. one of which might be AI. And AI, some people hold out great hopes for what that will do for our economy. The companies of today, the so-called Magnificent Seven that account for 30-odd% of the S&P 500, are some of the greatest companies we've ever seen. They have incredible technological leads, moats, market shares, incremental profitability. I mean, when the market is strong, it's never without a seed of reason. The only question is whether it's sufficient, and more importantly, when the market is incorporating unusual optimism, one thing that introduces is room for disappointment. And if the reasons for the optimism tend not to be realized, then you can have some real damage done. So it's a balancing act. I never want to give the impression that the arguments are all on one side or the other. But there's no doubt about the fact that the market today incorporates optimism, and that has certain implications.
In fact, I mean, the Magnificent Seven does, as you say, it encompasses companies that really are. NVIDIA is the chip company that is making the chips that power AI. They're almost alone in parts of that space. So of course they deserve. And people should read people who are thinking, how do the markets work? Or I know how the markets work. I'm a genius investor. Should read your last memo, because you actually do this great job of walking through what does it mean to fundamentally value something? What are the components of that? One piece of it, and this is what over the course of your long career has sometimes set you apart, is the psychology. Investor psychology is a huge part of what drives markets. And of course, that's not something you find in a weekly government economic dispatch. That is more complicated. It's made even more complicated, Howard, at a time when the rules are being suspended. The rules as we understand them are just not to be counted on, right? The U.S. government's taking stakes in companies willy-nilly. They're taking a tithe of their revenues to China. These are strange times. So as a long-term investor, what does that do to the psychology?
Well, again, I generally agree with what you're saying. The main thing is that it introduces uncertainty, and uncertainty should be something we don't want. It's unpleasant. It introduces the possibility of error. You say the rules are suspended. Normally, the market operates that if uncertainty goes up, prices go down. This year, uncertainty has gone up and prices have gone up. Again, not without any justification, but I think it can't be argued that the market is expensive. It may become more expensive. People may continue to make money, but you're not, certainly things are not on sale.
You make this point. In fact, it's worth noting that, yes, those big seven stocks that we all know, the Alphabets of the world, the Metas, are very expensive, but maybe based on some of the things that you would say go into fundamental value, justified. They are going to power the future. But you also make the point in your memo that the broader market, the other 493 of the S&P 500, are also expensive by historical standards, which makes less sense. I want to get to one wonkish thing before we get to your advice, because people mostly want to know what they should do right now. But that is the bond market, U.S. government bonds everywhere, but certainly, U.S. government bonds everywhere, but U.S. government bonds are signaling fear. They're signaling that they're going to have to pay more to get people to invest there, or people are flocking there because they're afraid. Either way, does it seem like a really weird disconnect that what's happening in the bond market is happening in tandem with record stock prices? Instead of in my experience, it would be the opposite. When you see the bond market doing this, you would see people leaving stocks, and that doesn't seem to be happening.
Right. Usually there are three reasons for bond yields to go up. As you say, when the yield goes up, it indicates that investors are demanding more payoff to invest there. So there are normally three reasons. Number one is that the economy is doing extremely strong. Number two, that's not the case, as you indicated. Number two is that the overheating economy threatens rising inflation. Inflation seems to be somewhat benign, although there's worry about the implications of the tariffs for prices. But I think that the concern, which is reflected in rising bond yields, and by the way, rising yields mean falling prices. The fear that the rising yields reflect is fear about the deficit and respect for the dollar and things like that. And that should be quite worrisome. Again, this is maybe people don't understand the U.S. fiscal position, but I think it's the U.S., because of its preeminence 80 years ago, after the end of World War II, was given what I call the golden credit card. And if you have a golden credit card, number one, there's no credit limit. And number two, the bill never comes. And number three, the interest rate is unusually low. And we've had it for a long time. Mm-hmm. And if you had it, just think, listeners, what you would do if you had the golden credit card. And the answer is you would buy a lot of stuff and you would spend more than you make because you never have to pay the debt. And that's the way we've been acting. It probably comes under the heading of too good to be true. It probably can't go on forever. Nobody can tell you when it's going to stop or why. And Buffett said at his Berkshire Hathaway annual meeting in May, it's going to be a problem, but I can't tell you whether it's in 2 years or 20. But sobriety requires one to say it probably is going to be a problem at some point. And I think that's what the bond markets around the world are addressing.
Although, what one of my favorite sayings is the best thing about life is that we're graded on a curve. You only have to be as good as the next guy. The U.S. economy is still compared to others. And how long will that work in its favor? Is there another economy that could emerge?
Well, that's another similar question. And you phrase it right. I say the U.S. has been the best place in the world to invest. We call it American exceptionalism. Why? Respect for the free market, rule of law, dynamic economy, spirit of entrepreneurship and innovation, deep capital markets, excellent high education. On the one hand, those things are mostly still true. On the other hand, there's reason to think they're a little less true than they have been in recent decades. But where else can you get that combination? I think the U.S. is still the best place in the world. I say in the memo, it may be a little less best than it used to be. Mm-hmm. But where else? A lot of my clients are sovereign wealth funds, for example, or pension funds or endowments. And they may have, let's say, 75% of their money in the United States. If you're going to take it out of the United States, where are you going to put it? What's better? I mean, most of the other economies of the world are very slow growing. In the case of Europe, probably hamstrung by regulation. The other major economy in the world is China. But, with China threatening, bellicose, and allying with Russia, North Korea, Iran, are you going to put your money with that group? So I think, we've been talking for the last few years about something called TINA. I don't know if you know TINA, but it
Sure.
stands for there is no alternative. And in large part, there isn't. So as you say, graded on a curve, or maybe you would say best house on a bad block.
So it's so interesting, isn't it, that at a time when nations like Canada or investors or small businesses are thinking maybe China is my solution, China says, nope, I'm going to stand up and have a parade with North Korea and Russia, just in case you thought we were friendly. I found that so fascinating that China just simply doesn't care about we are going to live in this kind of this bipolar world, I guess.
I know. And one of the things I think about, Amanda, is just think where we would be today if when Russia invaded Ukraine, China had come out on the side of Ukraine rather than Russia. I think that China would be a hero. And maybe the answer in this discussion would be different.
Yeah. But unfortunately, they need Russia's backing for Taiwan. So the geopolitics of the thing, of course, for most investors, Howard, and certainly, I mean, a lot of the people that I talk to, it's got to be true. You talk to sovereign wealth funds, but you also talk to people who are just saying, look, my retirement savings are in the market and I don't know what to do. Should my next dollar go into stocks? Because talk about there is no alternative. If you want a return now, bonds are looking a little bit better right now. Historically, you would have said bonds are an alternative right now. We're so greedy. We're so accustomed to these massive bounces up in stock prices that we won't do it. What do you tell people who are worried about these markets?
Well, first of all, we should put on the table the fact that my firm, Oaktree Capital Management, is not in the stock market. It's in the credit markets, the bond market. So, I mean, so everything I say over the next 5 minutes will be what we call talking my own book. But
and only you would point that out up front. Thank you.
Thank you. But interestingly, I wrote a memo called Sea Change, December of 22, saying that anybody who's come into this business since 1980 has only seen declining or ultra low interest rates, and I think that's over. And I note in particular the period from the beginning of 2009, when the Fed took the Fed funds rate to zero to fight the global financial crisis, to the end of 21, when it gave up on inflation being transitory and decided it had to raise rates to fight inflation. Over that 13-year period, remarkably, the Fed funds rate, which is our primary barometer of short rates, was zero most of the time.
Yeah.
So people are biased to think in line with what they have lived through recently. They think that's normal. And when rates were so low, just go back 3.5 years to the beginning of 22, cash paid zero in the bank. Treasuries paid 1 something, high grade bonds paid 2 something, and high yield bonds paid 4. So, nobody liked these things. In fact, they were, as you say, attracted to the stock market. The S&P 500 has returned 10% a year on average for the last century. That's enough to turn $1 into roughly 15,000. Not too bad. So people got into the habit of buying stocks regardless of valuation and ignoring bonds because of the low yields. Things today are very different. Today, the Fed funds rate is 4.5. The 10-year Treasury yield's 4.5. The 30-year Treasury yields goes to 5. I wouldn't recommend it because it's too subject to shocks, including inflation. But these are much higher yields, and the things we do, like high yield bonds, yield in the 7s, and so forth. That's pretty good. Now, for the individual, in a retirement account, no, but for an individual, bond income is taxed at ordinary rates, not capital gain rates. So you have to take that into account. But still, 7 from what we call credit, non-government bonds, is pretty damn good. The other thing is stocks are expensive. And at the end of 24, J.P. Morgan had published a chart showing that if you bought the S&P 500 at a time when the PE ratio, the main metric of value, was 23, which it was at the time, the return over the next 10 years on average was between 2% a year and minus 2% a year. So let's say 0. So stocks are more expensive and destined to yield less. Bonds have significant yields. I think fixed income can play an important and more importantly, reliable role in retirement accounts.
So let's talk about the shift that you just made, because you've been watching this market, as you say, since last year. You've been talking about its valuation. In your last memo, your August memo, you did make a change in what you're thinking about here. Just describe what that is. You're not saying run for the hills, but there are some, I would say orange lights flashing at least, Howard.
Right. Well, at least yellow. But, the memos, as I mentioned, I've been doing it 35 years. I started in 1990. I wrote those memos for 10 years before anybody ever responded. Not only did nobody ever say it was good, nobody ever said I got it. And yet I persevered, and I can't remember why. But then on the first day of 2000, I wrote one called Bubble.com, saying that I thought there was something suspect going on in the market for tech stocks, and the tech bubble crapped out almost immediately. So that as I say, after 10 years, I became an overnight success. At the beginning of this year, I wrote a memo to celebrate the 25th anniversary called On Bubble Watch. And I said, everybody's looking for a bubble. Things are elevated, but I don't think it's a bubble, because a bubble is characterized by just crazy psychology. And I did not detect that. I still don't detect crazy psychology. But, Amanda, as we said earlier, but stocks have gotten more expensive as the year has gone on. Mm-hmm. And so, I said in the recent memo, Calculus of Value, that Nancy and I like to watch action movies. And when the bad guys threaten the United States, the Pentagon declares, like DEFCON 2, Defense Condition 2. And I don't like going on TV or doing newspaper articles. They always say, well, should we buy or sell? Buy or sell, hold or dump. And the world is not black or white. It's gray. It's always gray. And anybody who understands how the world works understands that it's always gray. Mm-hmm. And it's never risk on or risk off. But I think that we should manage our portfolios conscious of our balance between offense and defense. And we can change that balance given what's going on in the environment. So I said in the memo that I recommend possibly going to InvestCon 2. Now, if you decide you want to be a little more defensive than usual for whatever your usual is, you can go to DEFCON 1, which is stop buying. DEFCON 2, which is tilt your portfolio more toward defense, sell some of your aggressive holdings and buy some more defensive holdings. Number 3, which is get out of all your aggressive holdings. InvestCon 4 is sell some of your defensive holdings. DEFCON 5 is sell all your holdings. And number 6, DEFCON 6 is go short the market. And I'm never confident enough. It's not my nature to be confident enough to go to 5 or 6. But I think it's reasonable at this point in time to just be at DEFCON 2, which is to say, just to start biasing your portfolio more towards defense and less towards offense. I'm not saying get out of the markets. I'm not saying don't have investments. And I'm just saying maybe you should shift some of your investments towards lower returning things, which offer more safety.
So I want to ask you, because that's a really good frame for people to be thinking about. And this is all, people will even ask me, I don't give financial advice for a living. And people will say, what should I do? It's so deeply personal for so many reasons. So people can take that frame. It's a beautiful thing. They can go figure it out. But overlay on it, Howard, in all of your decades of watching the credit market, the equities markets, and understanding how the fundamentals might work and all the nuances of the humans involved, we now have one particular human who's very involved. And I actually wrote a thing last week that some people would think was hyperbolic that said, the day that the U.S. government took a 10% stake in Intel is arguably the day that capital markets died, as we know them. And the reason I said that is not because governments can't take stakes in companies. It's because the CEO of that company didn't raise a fuss. There could have been a legal pushback. There could have been a PR pushback. Instead, we're seeing Intel, NVIDIA, AMD, big companies, steel companies, just say, yep, this is just the price we're going to pay. It's a bit of graft. It's a bit of a bribe. Who knows what you want to call it? I don't want to defame anybody. But this is not the way capital markets work. So when the rules are suspended, and you mentioned Fed independence, we might see the U.S. turn into Turkey, where your central bank is just ruled by the executive office. Terrifying thought for investors. What do you do about that? You don't know for sure if it's going to happen. You don't know when it's going to happen. What do you do?
Well, this is in general, this is when I suggest increased defense, this is what I'm thinking about.
Yeah.
And the point is if you buy what we call fixed income securities like bonds, you have a promise of interest and a promise of getting your money back at the end. And if the bond issuer, the borrower, doesn't keep that promise, they go through bankruptcy and the creditors get the company. So they have a lot of incentive to do so. And so we have our sector in the industry. Our sector is called fixed income because the outcome is fixed. And so today you can get, let's say, 4.5% from a 10-year U.S. Treasury with, I would say, 100% certainty, and let's say 7% from high yield bonds with 99% certainty. That's been our experience so far. 99% have paid every year. Those are decent returns, fully taxed, but it's good to have some of them to even out the fluctuations in your portfolio. I wrote a memo called Ruminations on Asset Allocation roughly October of last year. And I said there are two kinds of asset classes, owning and lending. And, I think you do a good job, Amanda, of putting things in simple terms. So I'll try to emulate that. Your brother-in-law wants to start a business, and your spouse says you have to give him money. You have two choices. You can lend him money in the hope that he'll pay you interest and you get your principal back at the end. You're not involved in the business. You don't rise and fall with the success of the business, but you hope to get repaid at the end. Or you can become a partner, and if he kills it, you do well, and if he does terribly, you lose all your money. Ownership or lending. Stocks are ownership, bonds are lending. If you shift towards lending, because it's safer, you usually give up return, but you offload a great deal of uncertainty. If you stay with ownership, you have the possibility of a much higher return, but also the possibility of a low return or a negative return or a total loss. So every investor at every point in time has to ask themselves, what do I want? Do I want to maximize my potential return, or do I want to minimize the uncertainty I face? You can't do both at the same time. I said in one of my books that people come to me for financial advice, friends, and they ask what they should do. And I say, well, which is more important, to keep what you have or make more? And what did they say? Both.
Yes. Yeah.
You can't maximize both. You can't maximize the probability of increasing your wealth and maximize the probability of holding on to what you have at the same time. Everybody has to make a choice. And I think it's reasonable to alter your choice as conditions in the world change.
Let me ask you, as somebody who's been doing this for so long, who's been watching so closely what's going on politically in your country, geopolitically around the world, with tariffs, with changes in behavior around how capital markets function, will we ever revert to normal? Will the U.S. market go back to normal, do you think? Or is this just a new era where we just need to accept that there will be uncertainty and change and maybe even inflation and tariffs and all the rest of it?
I think we can go back toward normal. I think that, President Trump does not consider himself bound by convention, norms, or what his predecessors did. So he's willing to do things like tell the Fed what to do, which presidents usually don't do. He's willing to take stakes in companies, which the United States government usually doesn't do. He's willing to impose tariffs unilaterally. And clearly the many things he has done have been outside the box and have introduced uncertainty. And I think that there's a good chance that subsequent presidents will be less so. So I think we can move back in the direction of what we traditionally have seen. By the way, I didn't mention one thing. You asked me a direct question that I didn't answer, because I said that the bond markets yields are rising because people are demanding more, largely because they are worried about the U.S. fiscal position and the affection for the dollar. Clearly, if anybody believes that that's really a problem, you can invest in foreign currency. You can buy not U.S. bonds, government or corporate, but you can buy
Canadian.
European bonds, Swiss, Japanese, and
Canadian.
Pardon me?
Canadian.
Canadian. There you go. And by the way, you said before that you thought that the tariffs on Independence Day were a surprise and perhaps unwarranted. I was in Canada on Independence Day, and when I got up to speak, I said, "I just want you to know I'm one of the hundreds of millions of Americans who think Canada didn't do anything wrong." And as you can imagine, I got a big hand. But
yes.
So if you want to, you can go into a mutual fund that invests in non-U.S. bonds. Non-U.S. companies are less dynamic, but on the other hand, you can reduce your dependence on the dollar. And if the dollar weakens, you'll end up owning more dollars because you owned pounds instead, or euros, or yen, or something. So that's another possibility. And you started off, I think, today, Amanda, by saying none of this is easy. And it's not. It's a complex field. It requires expertise. Charlie Munger, Warren's partner, who passed away a year and a half ago, said to me, and I put it in my first book, none of this is meant to be easy. Anybody who thinks it's easy is stupid. The worst thing you can do in the world is overlook complexity and think things are easy. Because if you do, you're likely to be victimized.
I do want to ask you, just to circle back, you said subsequent presidents. The DEFCON 1 of U.S. politics is that there aren't subsequent presidents, that there's something even bigger afoot here. You're not in that camp?
It's hard to imagine. The Constitution says the president is limited to 2 terms. So I guess the other possibility is we stop having presidents. But I don't think we're going to do that. And I don't think any president is ever going to get more than 2 terms. Once you start preparing for things that are absolutely outlawed in the Constitution, then we have bigger things to worry about.
Fair enough. Generally speaking, it sounds to me like even though you're cautious, you're still an optimist about the markets. Is that a fair statement?
Well, when you say the market, I'm less optimistic than usual about the U.S. stock market. I think if you invest, in the S&P 500, your return over the next 10 years will be in low single digits. So that's not optimistic. I'm not panicked. And the most important thing, if you're going to play in this game and be investing, you better not panic. Because if you permit yourself to be ruled by your emotions, you will constantly do the wrong thing. And I don't panic, but this is not the time for a carefree attitude.
Unfortunately, we have to leave it there, Howard, but it is such a pleasure to have you with us. Thank you for your time.
It's my pleasure, Amanda. Thanks for being with me.
We've been speaking with Howard Marks. Before you go, here are 3 things we think are worth watching this week. A cabinet retreat in Toronto was focused on strategy for reaching a deal with the U.S., but the Prime Minister did say he's thinking ahead to the budget. It will be one that reins in government spending. He called it an austerity budget. We won't, though, until we see where the money goes. The Quebec government finally pulled the plug on its Northvolt battery facility dream and on the $270 million it has already spent on the Swedish company in the hopes of creating 3,000 high-end manufacturing jobs. The writing's been somewhat on the wall since Northvolt declared bankruptcy in Sweden last spring. And the finance minister has given Canada Revenue a deadline to come up with a 100-day plan to improve its service. This is after reported delays and access issues at its call centers. The agency's laid off more than 3,000 people in the past year, so the solution may be easier than you think. And 100 days is a lot longer than taxpayers get to deliver what they owe. That's WONK for this week. I'm Amanda Lang. Thanks for being with us.